In the quiet hours before dawn, while the world scrolls through headlines and chases the next prediction, a different kind of wealth is being built, not through speed, not through the illusion of outsmarting everyone else, but through something far rarer and more enduring, a complete shift in how one perceives the game of money itself. There exists an investment strategy so simple in its essence, yet so psychologically demanding in its execution that it has quietly outperformed the brightest analysts on Wall Street, the most advanced quantitative models, and the most aggressive professional traders for generations. It does not rely on forecasting the unpredictable. It does not require constant trading or access to privileged information. Its power lies in its deliberate refusal to participate in the frantic rituals that define most financial lives. The uncomfortable truth staring back at every one of us is this: the financial markets, over long periods, act as a subtle mechanism for transferring wealth from those who cannot master their own minds to those who have learned to quiet them. Most people feel this truth in their bones during sleepless nights after a market drop or a missed opportunity, yet they continue to behave in ways that ensure they remain on the losing side of that transfer, reacting, speculating, and hoping rather than owning and waiting. What if the path to genuine financial independence was never about discovering some hidden formula or timing the market's every twist? What if it began the moment you stopped seeing investments as lottery tickets and started viewing them as partial ownership in real, living businesses? By the time this journey concludes, you will have internalized a philosophy of capital that has stood unshaken through crashes, booms, wars, and technological revolutions, not as a checklist of tactics, but as a profound transformation in identity, from anxious spectator to calm owner. This is not another fleeting promise of easy riches. This is an invitation to step into a way of thinking about money, time, and value that demands everything most people are unwilling to give: patience, rationality, and the courage to remain still when the world is screaming to move. Stay with me. The shift that awaits may be the most important decision your future self will ever thank you for making. Look closely at the lives unfolding around you, and you will see the same quiet tragedy repeated in millions of homes. People work diligently, earn respectable incomes, yet remain financially trapped, not by lack of effort, but by invisible forces that operate deep within human psychology. The first of these forces is emotional investing. Markets rise on waves of collective optimism, and suddenly the average person feels compelled to join the excitement, buying at prices inflated by euphoria. Then fear arrives, perhaps triggered by a single headline or a dip in the numbers, and the same person sells in panic, crystallizing losses that could have been avoided with nothing more than composure. This cycle is not a flaw in the markets. It is a flaw in the way we're wired. Our brains evolved to respond instantly to threats and rewards in a world of immediate survival. The modern market exploits that ancient wiring, turning every price fluctuation into an emotional event. The result is a lifetime of buying high and selling low, all while believing one is being prudent. Layered on top of this emotional turbulence is the employee trap. For decades, society has conditioned us to trade our finite hours for a paycheck, convincing us that a steady salary represents safety. Yet safety is an illusion when your entire financial life depends on the continued willingness of someone else to employ you. Every year spent in that exchange is a year in which your most valuable asset, time, cannot be compounded. The paycheck arrives, covers expenses, and leaves little behind to work on your behalf while you sleep. Then comes lifestyle inflation, perhaps the most insidious trap of all. Each promotion, each bonus, each small increase in income is quietly absorbed by a larger home, a newer car, finer vacations, and the subtle social pressure to signal success. What feels like progress is actually stagnation. The gap between earnings and true wealth remains unchanged because spending rises to meet income. The future self who could have been free is sacrificed on the altar of present comfort. Underneath it all lies the deepest psychological barrier: short-term thinking. We crave visible progress. We want the satisfaction of quick wins because delayed rewards feel abstract, almost unreal. The financial industry understands this perfectly and feeds it with daily news cycles, minute-by-minute price updates, and products designed for constant activity. The result is a culture where patience is mistaken for passivity and discipline is seen as boring. Most people never escape this gravitational pull. They remain financially stuck, not because they lack intelligence, but because they have never confronted the emotional and habitual patterns that quietly govern their decisions. Yet there is a way out. It begins with a single radical reframing that changes everything. The core principle of the investment strategy that has consistently outperformed the so-called experts is this: treat every investment as the purchase of an entire business, not as a piece of paper to be traded. You are not buying price charts or momentum or stories. You are becoming a partial owner in real enterprises that produce goods or services people want year after year. Shift moves the focus away from what the market is quoting today and toward what the business is intrinsically worth over the long arc of time. Once you adopt this ownership lens, short-term price movements lose their emotional grip. You begin to evaluate companies the way a thoughtful entrepreneur would, by asking whether the underlying economics are sound, whether the business can endure, and whether the price you are paying provides a reasonable margin of protection against the unknown. This principle demands rational decision-making over emotional reaction. It insists on discipline when the crowd is euphoric and calm confidence when fear dominates. And above all, it honors patience as the ultimate multiplier. This is not speculation dressed in new clothes. It is the disciplined allocation of capital to high-quality enterprises held for the long term. The experts who trade for a living are paid to generate activity, their incentives reward movement, fees, and short-term performance. The owner-investor has no such constraint. You are free to wait, decades if necessary, for the full value of the business to unfold. History has shown again and again that this quiet approach leaves the frantic professionals behind. From this ownership foundation flow several profound lessons that deepen and strengthen the strategy. The first is the discipline of staying inside your circle of competence. Before committing capital, you must honestly assess whether you truly understand the business, its products, its customers, its competitive landscape, and the forces that could threaten it. This is not about limiting yourself to boring industries. It is about refusing to invest in stories you cannot verify with your own reasoning. Consider the countless professionals who ventured outside their knowledge base during the technology boom of the late 1990s, pouring money into companies who see business models they could not explain. Many lost fortunes when reality reasserted itself. The owner-investor who respects their circle of competence avoids this trap entirely. They may miss some exciting opportunities, but they also avoid catastrophic mistakes. Over decades, avoiding permanent loss of capital proves far more valuable than capturing every fleeting trend. In daily life, this lesson translates simply: before buying any asset, pause and ask yourself whether you could explain the business to a knowledgeable friend without relying on hope or hype. If the answer is no, walk away. The market will always offer new chances tomorrow. This brings us naturally to the second lesson. Seek out businesses protected by durable competitive advantages, what some call economic moats. A moat is anything that allows a company to maintain high returns on capital for many years despite competition. It might be a powerful brand that creates customer loyalty, a cost structure that competitors cannot match, a network effect that grows stronger with scale, or regulatory barriers that protect the franchise. Without a moat, even a good business eventually erodes under competitive pressure. With one, earnings can compound reliably for decades. A classic illustration of this principle in action is a company like Coca-Cola, acquired in significant size in 1988. The business possessed one of the strongest consumer brands on earth, a global distribution system built over generations, and a simple product that required almost no technological change to remain relevant. Year after year, people around the world reached for that familiar taste. The moat was psychological and cultural as much as operational. An owner-investor who recognized this strength did not need to predict quarterly earnings or react to short-term challenges. They simply held ownership and allowed the business to compound its earnings, reinvest wisely, and return capital to shareholders over decades. The same logic applies today to any enterprise you study. Does it have a defensible position that competitors will struggle to breach? If the answer is yes, and the price is right, patience becomes your greatest advantage. The third lesson flows directly from the first two. Always insist on a margin of safety. Even the strongest business can face unforeseen difficulties, economic downturns, management missteps, or shifts in consumer behavior. The margin of safety is the discount you demand between the price you pay and your conservative estimate of the business's intrinsic value. It is your buffer against error and against the unpredictability of the future. Without it, even a wonderful company bought at full price can become a mediocre or losing investment over time. This principle protects the psyche as much as the portfolio. When you buy with a margin of safety, temporary price declines no longer feel like personal failures. They feel like opportunities, or at worst, irrelevant noise. In practice, this means developing the habit of estimating a business's worth based on its earning power, assets, and growth prospects, always erring on the side of conservatism. Then you wait patiently for the market's manic partner, as it has been described in investing lore, to offer you that business at a meaningful discount. Most people never develop this skill because it requires both intellectual humility and emotional restraint. Yet those who master it gain an almost unfair advantage. They can remain calm while others panic, and they sleep soundly knowing their capital is protected by a deliberate cushion. As these lessons integrate, the fourth reveals itself with quiet power, the extraordinary force of patience married to compounding. Time is the one resource that cannot be manufactured. When you own high-quality businesses bought at sensible prices and allow their earnings to reinvest and compound, small amounts of capital can grow into life-changing wealth, not through brilliant predictions, but through the steady, invisible mathematics of growth building upon growth. A business that earns 15% on equity and reinvests wisely does not need dramatic events to create substantial value. It simply needs decades. This is why the owner-investor can ignore daily price quotes entirely. The real growth occurs inside the business in the form of retained earnings, improved operations, and expanding markets. External market volatility becomes background static. In real life, this lesson asks you to examine your own habits. Are you reinvesting dividends and new savings consistently into the same high-quality enterprises? Are you resisting the urge to tinker or chase yield? The person who answers yes begins to experience the psychological freedom that comes from knowing their money is working silently on their behalf year after year, regardless of what headlines scream. The final lesson ties everything together: the courage of independent thinking and the willingness to say no. The world is filled with noise, analyst reports, social media consensus, urgent predictions. The owner-investor who has defined their circle of competence, identified true moats, secured a margin of safety, and embraced patience learns to tune out that noise entirely. They develop the confidence to act only when their own analysis justifies it, and to sit on cash when no opportunity meets their standards. This ability to say no is one of the rarest and most valuable traits in capital allocation. It prevents overpaying, over-diversifying into mediocrity, and overreacting to temporary events. Taken together, these lessons form a cohesive philosophy that does not chase the market, but stands apart from it. They transform investing from a game of prediction into a practice of ownership, rationality, and time. Now picture what unfolds when someone fully embraces this philosophy and applies it consistently, not for months, but for 5, 10, or 20 years. The transformation is both financial and deeply personal. At first, the progress feels almost imperceptible, like watching an oak tree grow. Yet beneath the surface, compounding begins its work. Each year's retained earnings generate additional earnings. Each reinvested dividend buys more shares that themselves produce further dividends. Slowly, almost magically, the portfolio begins to grow faster than any salary ever could. After 5 years, the early anxiety of market fluctuations has largely dissolved. You have lived through at least one downturn and watched your rational decisions hold firm while others sold in fear. Your confidence in the process deepens. By year 10, the numbers on paper have become meaningful. The silent accumulation has created a cushion that provides options, perhaps the freedom to reduce work hours, to support family members, or to pursue a long-delayed passion project without financial terror. The psychological shift is profound. Money is no longer a source of stress, but a quiet ally. You wake up knowing your capital is working harder than any employee ever could. After 15 or 20 years, the transformation is complete. What began as disciplined saving has become true financial independence. You possess the ultimate luxury, freedom of time. You can choose how to spend your days because your ownership stakes continue generating income whether you are present or not. The lifestyle inflation that once threatened to devour progress has been replaced by mindful spending aligned with genuine values. Relationships improve because financial worry no longer poisons conversations. Most importantly, you have become a different person, calmer, more reflective, less reactive to external events. You have internalized that wealth is not a destination, but a byproduct of living by principles that honor time and rationality. This future self is not a fantasy. It is the natural outcome of anyone who chooses ownership over speculation, patience over impulse, and intrinsic value over quoted price. The markets will continue their cycles of fear and greed, but you will remain anchored, watching the same principles compound both capital and character. And so we return to the central truth that opened this journey. The investment strategy that beats every expert is not a secret formula locked away in elite circles. It is available to anyone willing to do the inner work of mastering their own mind. It requires no advanced degree, no special connections, and no ability to predict tomorrow's headlines. It asks only that you commit to thinking like an owner, to acting with discipline when discipline is unfashionable, and to giving time the respect it deserves. The experts will continue to trade, to forecast, to charge fees for activity. Let them. Their game rewards motion. Yours rewards stillness. The question that remains is not whether these principles work. Decades of evidence have already answered that. The question is whether you will choose to live by them starting today. Take one quiet moment right now. Close your eyes and ask yourself, what is one small action I can take this week that moves me closer to ownership rather than speculation? Perhaps it is opening an account dedicated solely to long-term holdings. Perhaps it is reviewing your spending to protect the margin of safety in your own life. Perhaps it is simply choosing to study one business deeply instead of scrolling through opinions. Whatever it is, act on it. Your future self, the one enjoying freedom, peace, and quiet abundance, is waiting. If this exploration has stirred something in you, if you feel the pull toward a deeper relationship with money and time, consider joining others walking the same path. Subscribe and stay close as we continue to examine the principles that turn ordinary capital into extraordinary lives. But remember, the real work is not in watching. The real work is in applying what you now understand. The markets will test you. Time will reward you. The choice, as always, remains yours.